The last group of ratios we cover in this lecture is the market value ratios. Market value ratios compare a company's performance with its stock price, or say the market value. It gives us an idea of what the stock market or the investors think of the company's performance and future prospects. Generally, high expected growth in earnings and cash flow increases the market value ratios, and high risk of expected growth in earnings and cash flows decreases the company's market value ratios. Generally, market value ratios include the earnings per share, or say EPS ratio, which is a company's profit for each outstanding share of the common stocks, and the cash flow per share ratio, which is the amount of cash flow generated in a year divided by the number of shares outstanding. Also, the PE ratio, price over earnings ratio. This is the company's current share price compared to its per share earnings, or say compared to its EPS. It tells us how much investors are willing to pay for $1 of the earnings of the company. And we also have the price over cash flow ratio. So that is the current stock price compared to its cash flow per share. And then we have book value per share ratio, which is the book value of common equity for each outstanding share of common stock. And the last one is the market over book ratio. We kind of talked about this before. This is the current stock price compared to its book value per share. To calculate these market value ratios, of course, we would need the company's market value, or say stock price, and the number of shares outstanding. So if we do have the current stock price of $12.17 per share, and the company has 250 million shares outstanding, then EPS, earnings per share, is calculated as the total net income divided by the number of shares outstanding. So total net income is from the income statement, and number of shares outstanding is just given as 250 million. So in this case, EPS is calculated as $1.01. And then the PE ratio is calculated as the price per share divided by EPS. Price is $12.17 per share, and EPS we just calculated, and it's 1.01. So the PE ratio for this company is about 12. Here we use the current stock price comparing with 2017 estimated earnings. The PE ratio calculated this way is also called the forward PE. If we use the 2016 earnings number instead, then the PE ratio result will be called the trailing PE. We can also calculate the cash flow per share. Here we use net income adding back depreciation as a rough estimate of the total amount of cash flows generated by this company this year. So adding 120 depreciation back to net income, and then divided by the $250 million shares outstanding, we have cash flow per share as $1.49. Price over cash flow ratio then is calculated as the stock price divided by the cash flow per share that we just calculated, and we get the result of 8.2. To calculate the book value per share, we use the amount of book value of common equity divided by number of shares outstanding. So for this company, it turns out to be about 7.91. And for the market over book value ratio, the market value is the stock price per share, while the book value per share is what we just calculated as 7.91, so the MB ratio is 1.54. So far, we went over all 5 different groups of financial ratios for the ratio analysis. Here, let's also introduce another technique in financial statement analysis, that is common sizing financial statements. So to make more sense out of the financial statements and ratios, we can perform the so-called comparative analysis. Common sizing is one way to conduct the comparative analysis. It means displaying items on the financial statements as percentage of a common base figure instead of the dollar amount themselves. Formatting financial statements this way reduces the bias that can occur when analyzing companies of different sizes. It also allows for the analysis of a company over a different time period. For example, it can reveal what percentage of sales is the cost of goods sold and how that value has changed over time. To common size of balance sheets, we divide everything or every account by the amount of total assets. And to common size an income statement, we just have to divide everything on the income statement by the amount of total revenue, or say total sales. Here we have a sample common size balance sheet. As we just mentioned, you want to divide every balance sheet item by the amount of total assets. So total assets here is always 100%. And then if you look at the inventory in 2015, the inventory is about 48.7% of the value of total assets. And if you look at the cash in 2016, that's about 0.3% over the total value of total assets. For the liability and equity part of the balance sheet, same idea. You want to divide every item by the amount of total assets. So, for example, in 2015, account payable is about 9.9% of the total liability plus equity, or say 9.9% of the total asset value. And long-term debt in 2016 is about 34.6% of the total liability and equity, or say 34.6% of the total assets. So now with all these percentage numbers on the balance sheet, it's easier for us to conduct comparative analysis for the balance sheet accounts. The company has higher proportion of inventory and current assets than the industry average. And this is consistent with the ratio analysis results we got before. The company now has more equity, which means less debt than the industry. In addition, the company has more short-term debt than the industry average, but less long-term debt than the industry average. Again, all these conclusions are obtained by looking at the percentage numbers. If we want to common size the income statement, we want to divide everything by the amount of total sales, or say the total revenue. So each year, the sales is always 100% of its own value. And then, for example, cost of goods sold is 83.4% of total sales in 2015. And the EBIT result is about 0.3% of the total sales as of 2016. So if we look at all these percentage numbers, we can see that this company has lower cost of goods sold than the industry average. And the depreciation expense in 2017 is expected to be lower, but the other expenses actually are expected to be higher. So then the result is that the EBIT is 7.1% of the sales, which is pretty close, actually very similar to the industry average. Another part of the comparative analysis is the trend analysis. To perform the trend analysis, we calculate the percentage change from one account over a period of 2 years or more. So first, we calculate the amount of the increase or decrease for the period by subtracting the base year from the later year. If the difference is negative, the change is a decrease, and if the difference is positive, then it is an increase. And then we divide this change by the earlier year, or say the base year's balance. The result is the percentage change. In the next few slides, we're going to use 2015 as the base year to show you the trend analysis application. In this income statement, you see the percentage change of every account from its amount in 2015. So that's why in the column of 2015, it's always 0 because we are using 2015 as the base year. Then in 2016, sales increased by 70%. And sales is expected to grow over 105% over 2015 number in 2017. And cost of goods sold is expected to grow about 102.5% from 2015's amount in 2017. So if you look at the net income actually decreased by about 200% in 2016, but then it is expected to grow about 188% from 2015 in the year of 2017. We can also use the trend analysis to look at the percentage change in the assets. So again, here we are using 2015 numbers as the base, and we look at the change of each area accounts in 2016 and 2017. We can see that the total asset is expected to grow about 139% in 2017, while sales is expected to grow only 105%, which is lower than the asset growth. So when we look at these numbers, we need to pay attention to the company's asset utilization and try to understand why sales actually grow, or say sales is expected to grow behind the asset growth. And on this slide, you have the trend analysis, or say the percentage change in the liability and equity part of the balance sheet. Now let's talk about the DuPont analysis. Recall that we mentioned that ROE is one of the most important ratios that investors look at. With DuPont analysis, we break the ROE into 3 parts to explain a company's ROE level and any changes in ROE. This name comes from the DuPont Corporation that started using this formula in the 1920s. If you look at the equation on the slide, ROE equals to the profit margin multiplied by the company's total asset turnover and then multiplied by the company's equity multiplier. This tells us that the DuPont system focuses on 3 prospects. The profit margin is affected by the company's expense control, and total asset turnover ratio reflects a company's asset utilization, and equity multiplier reflects the company's debt utilization, or say the level of leverage. And the DuPont equation shows how these factors together determine the ROE of the company. We did calculate the profit margin and total asset turnover in the previous couple of slides. So for 2015, 2016, and 2017, if you go back to all those slides and find the value of profit margin and total asset turnover, you can put those numbers here. And we can also calculate the equity multiplier, which is the total asset divided by common equity, and we can also find the value of this ratio of these 3 years. So we can verify that the ROE of each every year is the product of the 3 ratios introduced in this DuPont equation. So let's just put all these numbers here, and now let's take a look at the DuPont system. We see that the company's 2017 estimated ROE 13%. That's actually lower than the industry average of 18%. And that is mainly due to the low asset turnover and low leverage ratio, because in 2017 the asset turnover is 2 comparing to the industry average of 2.5, and the leverage, or say the equity multiplier, is 1.8 comparing to the industry average of 2. The profit margin in 2017 actually is the same as the industry average. So again, the low ROE for this company in 2017 is mainly due to the low asset turnover and low average, not really because of the low the estimated profit margin. So as you see, DuPont equation here can help us to understand what contributes to the high or low value of ROE. So far we have talked all these ratio-based analysis. We need to discuss the potential problems and limitations of the ratio analysis. We say ratio analysis can be very useful and helpful. However, it has limitations. Sometimes comparison with the industry average is just difficult if the company operates in many different divisions or many different industries. And sometimes for some companies, the industry is just very hard to define. Also, for some companies, there are not enough comparable companies in the same industry for them to provide an average for you to compare to. In addition, seasonal factors can distort ratios. Also, window dressing techniques can make statements and ratios look better. For example, to avoid reporting a low cash balance, a company may try to delay making payments for the amount that should have been paid between December 26th and December 31st. Then, on January the 2nd, the company issued checks for all of the amount that normally would have been paid at the end of December. This way, the numbers, or say the cash balance, would look better on the financial statements for December, or say for the end of this year. And that's a typical window dressing. Last point is, if different companies use different accounting and operating practice, the results actually can also distort the comparisons. Last but not the least, to reasonably assess a company's performance and prospect, we also need to consider many qualitative factors that are not necessarily reflected in the financial statement numbers or ratios. For example, there is greater risk if the revenue of a company is tied to a single customer or a single product, or it relies on a single supplier. I usually recommend my students to pay attention to the management discussion and analysis section of a company's annual report to look for some answers for important questions such as, what is the competitive situation the company is facing? What products are in the pipeline for this company? Or what are the legal and regulatory issues that the company is facing? To summarize this lecture, we can learn a lot about a company's operation and performance by looking at its financial statements, including the income statement, balance sheet, and statement of cash flows. Measures such as free cash flow, EVA, and MVA can help us understand how much value the company can create for its shareholders. 5 groups of financial ratios can help us understand a company's efficiency, performance, risk, and growth prospects. Common size financial statement and trend analysis help us to compare one company with another, or compare the company with itself over different periods. DuPont analysis breaks ROE into 3 parts to explain how ROE is affected by the company's profitability, asset management, and financial leverage. After our study of financial ratios, we should understand that among different industries, there are significant variations in financial ratios because of the differences in technology, products, or competitive structures. Within the same industry, the wide variation in financial ratios is often due to the differences in corporate strategy, in marketing, corporations, and finance. So let's take a look at the financial detective case from the casebook. In this case, you have 8 pairs of unidentified companies, and you are asked to match the company description with the financial profiles derived from those ratios. For example, between companies G and company H, according to their common-sized financial statements and financial ratios. Which one do you think is the leader in traditional book selling, and which one sells book, music, and videos solely through its internet website?